All right, today we are pulling back the curtain on the stock market. We're going to reveal an invisible war, one that's fought in microseconds. Welcome to the real world of high-frequency trading.
You know, when you look at a stock chart, what do you see? It's just a single line, right? Moving up, moving down. But that line, that's just the tip of the iceberg. Underneath, there is a chaotic, unbelievably high-speed battle of algorithms that are deciding that price second by second. So what is really going on down there?
Well, to see what's really happening, we're going to need a special kind of microscope. And in the world of finance, that microscope has a name: market microstructure. It's the absolute key to understanding how millions, and I mean millions, of buy and sell orders clash together to create the prices we all see on our screens. So let's zoom in.
All right, section 1, beyond the ticker tape. So our first look through this microscope is going to take us way beyond the simple ticker you see on the news. We're going into the actual environment where traders compete.
Now, for most of us, this might sound like some abstract academic theory. But for high-frequency trading firms, we call them HFTs, this is not theory at all. The world of microstructure, that's their battlefield. It's where fortunes are won and lost literally in less than the blink of an eye.
Okay, next up, inside the order book, where supply and demand meet in real time. So let's zoom in even further, right to the heart of this battlefield. It's called the limit order book, and it's where every single intention to buy or sell a stock gets recorded. Okay, so think of the order book like a live, constantly updating digital ledger. On one side, you've got the bids. These are all the outstanding orders to buy and the prices people are willing to pay. And on the other side, you've got the asks, all the orders to sell. This is the rawest, most fundamental picture of supply and demand you can possibly get.
Now, look closely. See that gap between the highest price someone is willing to buy for, that's the best bid, and the lowest price someone is willing to sell for, the best ask? That little gap is called the bid-ask spread, and it's basically the cost of doing business right now, of trading instantly. For a lot of traders, that tiny spread is their primary source of profit.
But here's the kicker. Not everyone gets to see the same order book. It's not a level playing field. See, most retail traders, you get what's called level 1 data. That's just the best bid and the best ask. That's it. But the pros, they need level 2 to see the depth of the book. And the HFT firms, they require level 3, which shows them every single individual order. The lesson here is simple. The more you can see, the bigger your advantage.
Section 3, the language of orders, the weapons of the microscopic battlefield. So, if the order book is the battlefield, then the orders themselves, those are the weapons. Let's break down the two most fundamental types.
First up, you've got the market order. This is the simplest, most aggressive command there is. It's basically you screaming, "Get me in or out right now. I don't care about the exact price, just do it." It's all about speed. And when you use a market order, you are what we call a liquidity taker. You're consuming the orders that other people have put on the book.
And then you've got the opposite, the limit order. This is a much more patient, strategic command. It says, look, I am willing to buy or sell, but only if I get this specific price or even better. By placing a limit order, you're not taking anything, you're adding your order to the book. You are becoming a liquidity maker for someone else to come and trade against.
So here's the crucial trade-off, and you really got to get this. A market order guarantees you'll get your trade done, but the price might slip a little from what you saw. A limit order, on the other hand, guarantees your price, but your trade might never happen at all if the market moves away from you. This choice, this fundamental tension between speed and price, well, that's at the absolute core of every single trading strategy out there.
All right, new section. Reading the aggressive flow, how traders predict the next move. So now that we understand the weapons, let's see how HFTs actually use them to try and predict where the market's going next. And spoiler alert, they are not looking at charts like we do. They're analyzing the raw flow of orders itself.
They use a really cool metric called order flow imbalance, or OFI for short. Now, simple trading volume just tells you how much stuff was traded. OFI is way smarter than that. It tells you who is being aggressive. It specifically measures the net pressure from those traders using market orders, the ones demanding to trade right now. And that, my friends, can be a huge clue about where the market's headed in the next few moments.
So here's basically how it works. When a big buy order shows up at the best price, or a seller suddenly cancels their order and pulls it off the book, both of those things signal that demand is getting stronger, so OFI goes up. And on the flip side, if a new sell order appears or a buyer cancels their bid, that signals supply is strengthening and OFI goes down. Think of it as a real-time pressure gauge for the market.
Okay, so how much of an imbalance is actually a big deal? Well, research has shown there's a kind of magic number, a critical threshold. When those aggressive buy orders start to outnumber the aggressive sell orders by a ratio of about 3 to 1, that becomes a really high probability signal that the price is about to pop upwards. And you can bet the algorithms are constantly scanning for that exact moment, 24/7.
Okay, next chapter, the nanosecond arms race, where speed is everything. But here's the thing, and this is absolutely critical. Having a signal like that OSPhi ratio is completely useless if you're not the first one to act on it. And this is what triggers a pure, unadulterated race for speed. Welcome to the nanosecond arms race.
And the rules of this race? They're set by the stock exchange itself. In what's called a FIFO, or first-in, first-out market, speed is literally everything. The first order to get to the exchange at a certain price is the first one that gets filled. It's that simple. But in a pro-rata market, it's not about being first. It's about being the biggest. The exchange fills orders proportionally, which rewards the players with the deepest pockets.
The one true enemy in this race is something called latency. It's really just a fancy word for delay. And it isn't just one thing either. You've got network latency, that's the physical travel time for your data. You've got processing latency, how fast your computer can actually think. And then there's exchange latency, how fast the stock exchange itself can process your order. Every single part of it matters. Every nanosecond counts.
And this is where you see the staggering, mind-blowing reality of this arms race. An institutional HFT firm can execute a trade in maybe 1/100th of a microsecond. They're using custom-built computer chips and microwave towers to send their signals. Meanwhile, a retail trader, even a fast one, is working in milliseconds over their standard internet connection. We are talking about a difference of several orders of magnitude. It's not even the same sport.
Which leads to the big question, your place in the game, a retail trader's reality check. So with all this in mind, what does it mean for you, for an individual trying to trade or compete in this environment? Where do you even fit in this insane high-speed game?
Well, for a retail trader, the single most critical decision you'll make is your choice of broker. You absolutely need one that allows for something called co-location. That means you can literally place your own server in the very same data center as the exchange's systems. This is how you get your latency down into the sub-millisecond range, which is just barely fast enough to even be in the same league.
But even if you get the right broker and co-locate your server, there is a hidden catch, a really big one. You see, many retail-focused brokers have a daily message cap. What does that mean? It's a hard limit on how many messages, that's orders, cancellations, updates, anything, you can send to the exchange in one day. A common limit is 2,000. The thing is, a real HFT strategy might burn through 2,000 messages in a couple of minutes. This cap makes true HFT practically impossible on most of these platforms.
And that really brings us to our final, and I think most profound, takeaway from all of this. Studying this invisible battlefield, it's not really about predicting the future. It's about deeply understanding the present. It's not about finding out where the price will go. It's about understanding the very mechanics of how price itself even comes to exist, moment by moment.